Hi, and welcome to the Week Ahead. I'm Tony Nash. Today, we are joined by Dr. Anas Alhajji for the first time. We're really glad to have you here, Dr. Anas. We're also joined by Michael Belkin and Tracy Shuchart. There's a lot to cover today. First, we're going to talk to Dr. Anas about $100 oil. We're then going to talk to Michael about equities and sector rotations that are happening in markets. And then we're going to talk to Tracy about LNG in Asia, which has been a story building over probably a decade, but it's really starting to break out. So before we get started, I want to let you know about a new free tier we have within CI Markets, our global market forecasting platform. We want to share the power of CI Markets with everyone. So we've made a few things free. First, economics. We share all of our global economics forecasts for the top 50 economies. We also share our major currency forecasts, as well as Nikkei 100 stocks, so you can get a look at what do our stock forecasts look like. There is no credit card required. You can just sign up on our website and get started right away. So check it out, CA Markets free. Look at the link below and get started ASAP. Thank you. So guys, thanks so much for joining us at the end of this week. I know there's been a lot happening this week, and I'm really, really grateful whenever you take your time here. So, Dr. Anas, let's start talking about the case for $100 oil. Obviously, we've seen a lot of movement in crude prices over the last couple of months, and there are supply constraints, of course, with Saudi and OPEC supply cuts and the extension of those cuts. But you put in a tweet earlier this week saying that there is no case for $100 oil, which sounds surprising a little bit. So I'd really like to hear your reasoning through that, if you can walk us through that. And I'm sure there are a lot of items that go into that calculation. So if you don't mind, can you walk us through that, please?
Sure. When we worked on our 2023 oil market outlook in December, and we published it on the 3rd of January, we made 23 predictions in that outlook. And it is available on the web for those who would like to check it out. And we made, in those predictions, basically, most of them were against the grain. And the title of it was 2023 is going to be the tale of two halves. That's what the title, and the title tells the whole story about the two halves. So the increase in oil prices, et cetera, all was predicted. We were very bullish on the fourth quarter of 2023. We expected the Chinese economy to be very weak, and you and I exchanged a few tweets on this throughout the previous month. We expected that. We expected Russian oil to continue to go to the market. But what we did not expect, despite the 23 successes of those predictions, we failed to see that Chinese are going to increase their oil inventories, and they increased it substantially. We failed to see that. And given their history that we studied over the years, it was very clear that they are going to use this build when prices go up. And they already started doing this. That's kind of messed up our very bullish fourth quarter. So we are no longer very bullish, we are just bullish. And if you look at all the factors that determine supply and demand in the market at this stage, and I repeat here because some people take this word, and in 2025 they said, you said no 100 in 2025. I did not say that. At this stage, and I think Tracy got burned several times with the same matter that I was burnt with when you say something and people put it in a different time frame. At this stage, there is no case for 100, simply because if you look at supply and demand, and the fact that the Chinese are releasing a lot of oil from their inventories. They already released about 35 million, and we expect them to release another 45 million in the next few weeks. So that's one issue. There are many other issues that people do not know about. Now, I understand what speculators do and algos and all that stuff, but they need a trigger. And one of the things, just to give you an idea how much people do not know, those who are especially very bullish, the Russians promised the Saudis to cut production by 300,000 barrels a day. And the Russians are cutting. And people see the numbers. What people do not see is that the Russians are playing the game of what is crude because they shifted to NGLs. And they reclassified the crude as NGLs. And their NGLs exports went up by 300,000, the same number they decided to cut.
It's all a statistical game, right?
When we look at, absolutely, when you look at OPEC and people show, look, Saudi production is declining, UAE production is declining, look, OPEC production is declining, OPEC plus production is declining. We've been saying for a long time that production does not matter, exports do, because supplies are what matter to the market. But after they build those massive refineries, what matters right now is the net exports, not the exports. Once you count the net exports, the decline is way lower.
Mm.
And therefore, of course, there are, I mentioned 23 prediction. There are many things to talk about. We don't have enough time. But the idea here is you start looking at those details. People are saying, what if Iran does not deliver? Well, no one counted Iran in the first place.
Mm.
No one counted Venezuela in the first place. So why you guys are counting them when you want to?
And it's just a very quick clarification. When you talk about exports versus net exports, for people who aren't energy market experts, why does that matter?
There are countries that have massive refineries that they take the oil from Russia or they take their own oil and they export it as products. If you don't count that in the equation, you are missing something from the equation because they are exporting both. So I'm just making up numbers. Let's say if a country exports 1 million barrels of crude and their products exports go from 100 to 300, their exports went up. Although if you look at the crude alone, it did not change.
Right.
So you have to count that. The other issue that we failed to see, because we have two failures in our forecast. The first one is we did not see the build in the Chinese inventories. Although we know the Chinese story, but we don't about releasing oil, but we did not realize that in 2023 they will build. The other related issue is we did predict that other OPEC members will buy Russian crude and Russian products. What we failed to see is the increase was fourfold our forecast.
Okay.
And that changed the whole dynamics because a country can cut production, but they can still consume the oil anyway.
Right. Okay. So has Russia been hurt by any of these cuts? I mean, by any of the energy cuts? It seems like it's just trade diversion more than really harm from these cuts.
Let me put it differently. Are they being affected by what's happening? Are they getting less money, etc.? Yes, there is no doubt they are hurting. But definitely it's not what Janet Yellen is saying. Okay, they keep talking about, let me give the audience just one example about this. The price cap and the sanctions were imposed on December 5th, 2022. 2 weeks later, Janet Yellen's office was talking about the price cap is working and it's reducing Russian exports, although the impact has not been done yet. Between the time the companies sell the oil, get the money, pay their taxes, the government collect the taxes, and reach the level of revenues, it takes 6 to 9 months. Those guys were talking about it 2 weeks later.
Right. So statistically, theoretically, it made an impact, but in fact, it hadn't made an impact yet.
The price cap never had an impact at all. We have a story of the history of sanctions for the last 200 years. Let's say 120, because most of the studies are done for the last 120 years. Every single study on sanctions in the last 120 years concluded that sanctions do not work, and there are always ways for the product to find its way to the market.
Yep.
This is a fact of life. So what the Russians were lucky because the Iranians were on their side, and the top expert in the world on this are the Iranians. So they took a page from the Iranian book and they made 1,000 books out of it.
Yep. So
and they perfected the game on their own.
Yep. So okay, so I'm really relieved to see your statement about $100 oil in 2023. Our CI Markets forecast product does not have $100 oil in 2023. We see things peaking in October, and then kind of slightly deteriorating into the end of the year. That may or may not happen, but what you're saying very much agrees with what we've forecast for months. So as we go into 2024, what are the dynamics that you're looking at? And do you see pressure for higher crude prices going into 2024?
We published a report on 2024, and then we updated that. We are still bullish, but we have a serious problem that we are still struggling with. We have the worst data quality or records. We never had, I mean, the quality of the data deteriorated substantially to the level that we are really, I mean, we have to work extra hard trying to kind of sort it out. We never had this problem before. And it's coming from all over. Today we published a report on the EIA adjustment and crude quality and shale. And the last statement, the conclusion was, the US with its might, it can send a rocket across the world and hit its target and cannot fix the adjustment in the data. I mean, that's how bad it is. And what happened is, supposedly, on the 1st of August, the EIA published a warning or kind of a press release saying that we fixed the problem, we found the blending things, and we are adding the NGLs, etc. We were happy to see the decline, and the adjustment just declined to the usual 200,000 a day. A week later, it multiplied by 5.
Yeah.
A week later.
Yeah.
So that shows you that we do have a serious problem in the United States. Now imagine with the dark Russian fleet, with the dark with the dark Iranian fleet, with the Syrians, the Sudanese, the Venezuelans, etc., how bad the data is. And then China basically is playing a game where one day the Iranian oil is coming to China from Malaysia, and the other day is coming directly, and the third day is coming from the UAE. I mean, it takes a lot of effort even to do that, and it's becoming too expensive for any analyst even to do the analysis right now.
Heads up for a short break.
Are you using the potential of AI in your portfolio management strategies? With an impressive 94.7% forecast accuracy on average, you can confidently integrate AI into your approach with CI Markets. Visualize the potential volatility of your portfolio over the next 12 months and gain insights into specific assets that might experience fluctuations. This empowers you to make informed decisions on when to buy, sell, or hold. CI Markets covers a wide range of over 1,600 assets, including stocks, commodities, Forex, indices, and economic indicators. Imagine running limitless portfolio scenarios to optimize your gains. Curious about the outcome of removing or adding certain assets? Wondering how your portfolio might evolve in the next 3, 6, or 12 months? CI Markets equips you with answers to these crucial questions. Whether you seek a streamlined portfolio analysis, wish to explore diverse scenarios, or aspire to track your investments with precision, CI Markets is the ultimate tool for you. Ready to learn more? Visit us at completeintel.com/markets.
Thank you. And now back to the show.
So, okay, so there's a lot of great data. So for people who are looking at that data, what is there a decent kind of proxy data to look at to understand what's going on, or is it just kind of a guess at this point?
It is mostly when it comes right now to the Russian crude, because whatever I say about Russian crude, and I'm convinced of, anyone can come in and say another number, and both of us are correct.
Right.
Okay,
So,
both of us correct. So, but one point about the data quality here. I mean, we have, just to show you how bad the situation is, we are coming to the situation, for example, yesterday there was a major report published, I'm not going to name the agency, talking about the CO2 emissions between Europe and India, and saying that India permanently now outpaces Europe. It's a complete nonsense, because Europe is in a recession, and in a recession you use more renewable energy and less fossil fuel.
Yep.
So just show you how data deteriorates. The other data deterioration is related to the fact, I know you are going to talk about EVs, so I will mention it and then we talk about it later, about how they report the EV growth in percentages, not in numbers.
Right. So tell me what that means. So you're saying, sorry, let me interpret that and make sure that's what. So you're saying the EV installed base is pretty low. So because it's pretty low, they're telling you about percentage growth to make it seem more important, when in fact the installed base of EVs is just pretty low. So if they just told you the numbers, it would be kind of a yawner. Is that fair to say?
Correct. For example, this is a true case where the number of trucks sold jumped from 400 to 900, around those numbers. But the report was, oh, the sales of this truck increased by 154%.
Right.
But they did not mention the numbers.
Right. Okay. That makes sense. Our observation is that macroeconomic data quality has deteriorated pretty bad in the past few years. So, it makes sense to me also that oil, crude trade and crude quality data has deteriorated as well. There's just some fuzziness in the past few years, and I just can't quite put my finger on it. Anas, before we move on to the next topic, can you help us understand the supply side dynamics? We've seen Saudi Arabia kind of continue their supply cuts into October. Do you think we'll continue to see OPEC pull supply off the market? Let's say if Europe continues to deteriorate, if Europe's economy deteriorates, if, let's say, U.S. consumers deteriorate and the U.S. economy deteriorates, do you think we could see OPEC extend their supply cuts and even grow the supply cuts into 24 if we see economies continue to deteriorate?
There is one fact that we have to realize here, that for Saudi Arabia in particular, they've been proven to be true on the demand side. OPEC was wrong. If you look at OPEC forecast, you look at the IEA, was wrong. And so what? Because the Saudis are adopting a policy of two legs. The policy is every month they ask Aramco and they say, look, tell me about what people are asking you for. They have their own clients. So what are the amounts that your clients are asking you for? And they tell them. And they have, and I am convinced that they have a contract with a company. It's an artificial intelligence company that measures sentiment. So they take the sentiment from the market, from the AI company, and they take the data from Aramco and decide what to do. So they get the first orders before you and I, and if any trader knows anything about the market, they have feel before anyone else. The data for the forecast for OPEC and IEA and everyone else, it comes later. Mm-hmm. So they have a feel of market before anyone else. And therefore, they really nailed it when it comes to the demand. The demand is not as strong as people predicted earlier this year. And because we already have this cut and we see where we are right now. So they have a feel. So this is the first fact. The second fact is, what do Saudis want? Because people really need to understand what they say. Well, they need to balance the budget. Look, this is just one tiny objective among many. There are many objectives. The budget and the money is just one part of it. It is extremely important for the Saudis to control the narrative. It is extremely important for the Saudis to be in the driver's seat. That's why they get angry when the speculators, after the banking crisis in the US, the recent one, the speculators basically took over, and then the media start publishing those weird, some of them fake news. And Tracy and I basically are familiar with those news that kind of becoming really annoying from time to time, where it's either fake news or, for example, it is part of corporate planning to study all scenarios. It's natural. So if they are discussing 7 issues and one of them mentioned we discussed this issue, it does not mean they are going to adopt that issue. But all of a sudden it's a headline news and the market is reacting to it. But the fact is, they want to control the narrative. They want to, yes, they want more money. Yes, they want some political gains out of it. Yes, they want some strategic gains out of it. Yes. But one important element this year that did not exist before, that they are going to be a super active participant in COP28. COP28 is going to start at the end of November for about 12 days in December. And it is in Dubai. So this is like in their backyard. And they want to go there and be a hero. And the reason why they want to be a hero, because they cannot be, remember that this is the first time the oil companies are part of those meetings. They were barred before. So they are going with the rest of the oil industry, trying to convince the other side to change the narrative. And you cannot change the narrative unless you are active participant and you are ahead of everyone. So you lower CO2, you build those big mega wind farms, and you build those solar, and you are using hydrogen, and you are planting trees. They are going to come in full force to show all those good things, that I am as good as any European country.
Yep.
And now you listen to me. So this is part of it too, because a reduction in output for 3 months bring us to COP28. A reduction in output means a reduction in CO2. At the same time, they are changing the narrative on the consumption side, because for over 40 years, the data from BP and NE and all the others, now if you go to the web and search for the top 10 consumers of oil, Saudi Arabia is always there. But that's a mistake, because they did not count the products exports. They count them as consumption. Saudi Arabia is not among the top 10 consumers, and therefore they count them as big emitter, because they are consuming that oil while they are not consuming it.
Well, it's like looking at Singapore as a consumer, right? I mean, Singapore has massive refineries, right? They couldn't possibly use all the oil they import.
Absolutely.
So they import it, process it, re-export it, right? So all of these things make a lot of sense. So they're going to get involved in COP28 really to have more control over the narrative going forward, right? So the vilification of oil and gas and the vilification of fossil fuels.
With the cooperation of others. This is very important. So they are going in with the rest of OPEC, China, India, the African nations, with the oil majors, especially the Europeans. And they are going there armed with all the facts of 2022, where they show that you Europeans, you reneged on everything you promised.
That'll be very interesting to watch. I can't wait. Perfect. Anas, this is great. So just conclusions. No $100 oil in 2023. You're still bullish going into 2024, but you're not super bullish. The Saudis and OPEC will get more involved in COP28, and over time we'll see, we'll say more, maybe a more friendly narrative to some of these traditionally fossil fuel producing nations. Is that fair to say?
Yes, on 2024, basically, the major issue we are facing is, I mentioned one, but I'm going to mention something else, since you are going to talk about LNG and EV, and Tracy is going to talk about that. So this is kind of a segue to it.
Great.
One of the big lessons that we learned in 2022 is that we've seen substitution among energy sources in a way that we never seen in history, where wind stops, natural gas prices go up, people cannot afford them. Now they want LNG. LNG goes up, and now they go back to coal. It rains, there is no coal. It goes back to wood, and then from wood goes back to oil. We never seen this before, and it's really quick, really quick.
Yeah.
So this is messing up our efforts to kind of sort things out, because we need to know the degree of substitution between all of those, and this is a big problem right now in the analysis of the future.
Yeah, I wouldn't have expected to see wood as a substitutional feedstock in 2022. That's really
or regional basis it is.
Yeah, yeah.
Or local, if you want to, but on regional basis we've seen that change.
Very interesting. Anas, this is perfect. Thank you so much.
You're welcome.
Let's go from energy to energy with Michael. Little bit of energy. Michael Belkin, thanks for coming back this week. You mentioned last month when you were on the show that you thought equities had hit the cycle peak, and we've seen headwinds in equity markets ever since. Your view is that equities have peaked, which is great, and we've got a screenshot of your newsletter. You also thought energy would start picking up, and you covered that a bit in your newsletter as well. Can you talk us through the cycle peak and energy? as you've kind of outlined in your newsletter?
Sure. Thanks for having me, Tony. So just to review what I do, so the Belkin Report is a forecasting service. I was a graduate of UC Berkeley Business School, and in the stat department, I studied time series analysis. So what I do is forecasting based on time series analysis. I developed my own proprietary model. It's similar to what I studied in Fourier analysis and Box-Jenkins, autoregressive integrated moving averages, but I came up with my own way. So my model gives direction, position, and intensity in a 12-period forward forecast. It works particularly well on sector rotation, and we used it in proprietary trading. I was the quant strategist in equity proprietary trading back in the early 90s at Salomon Brothers. Anyways, so that's what I do. My clients are big hedge funds, private family offices, big asset managers all over the world. So basically, I'm looking for what's going to happen next. Again, direction, position, intensity. Something going to go up, down. That's first thing, direction. Second is position. Where are we? Beginning, middle, end, and how strong is the signal? Okay, with that in mind, let me give you a forward look. So sometimes my forecasts sound very contrarian because the model basically likes to buy low and sell high. It's basically picking, trying to pick bottoms and tops and things, not just in markets, but in ratios, the way sector rotation works. Okay, so having said that, let's just say, where are we? So July 31st, that was the peak for the S&P, Dow Jones, Russell 2000, and DAX. The Nikkei peaked a little bit earlier, actually, July 3rd. So we're not down a lot from there. We're down like 3% for the US indexes, 8% for the Russell 2000 from their peaks, DAX down 5%. The stuff that people like the most actually peaked earlier and is down more. So New York FANG, which is the best measure of all these magic 7 stocks or whatever, it's an index you can follow. It's the top 10 large cap stocks in the US. That's down 5%, peaked July 18th. So we're a good 6-7 weeks past the peak in the stuff, but has that changed the appetite among buyers? Not a bit. It's kind of funny. I was thinking before I came on here, I think I dubbed this the Hunter Biden market. It feels so good at first, the pictures of Hunter Biden in his underwear with a cigarette in his mouth and a prostitute in the background, and he's smoking crack. So that's my facetious view of the people who are addicted to buying these AI stocks and tech stocks, which have already peaked. So, it feels good at first. And I'm not a perma bear. I was long this stuff, but my model turned very bullish last October. It's almost a year ago. And so anyways, but these peaked at beginning of the third quarter, end of the second quarter. And so just one little digression on that. If you look at the flows, Deutsche Bank puts out this cumulative flows chart, and it shows over the last year, tech is off the top of the chart, like that's all that people are buying, and energy is off the bottom of the chart. So, but that hasn't been working, right? So tech is underperforming now, energy is going up. So for instance, energy sectors were the only positive gains in the US and in Europe last month, August. Again, this week. So the S&P is down 1%. The XLE is up 2%, 3% positive alpha. And is anybody getting this? I mean, a little bit, maybe, but it's not. This is not a consensus popular trade. Buy energy. This is not something that's wildly popular by any stretch of the imagination.
Anas and Tracy would have told us the same months ago, just like you. I mean, it's really interesting to hear you say this, Michael, because this on energy is what Tracy's been telling us to wait for several months. So it's great to hear this.
So it's working again. So the model forecast, it looks sort of like a sine wave, where the left tail is the beginning of something, the middle of is the beginning. The middle is the middle, and the right tail is the end of something. Time is on the bottom axis. So where are we in the oil? I might differ a little bit from your previous speaker. So I'd say we're about half to 2/3 of the way through this move. So where are we? About $90 a barrel on Brent crude, a little bit below that for US crude. I could think it could go for another month or so. And energy stocks have not really become wildly popular yet. So basically we're in the fifth, sixth inning. If you think of a baseball game, 9 innings, that's where we are. We're halfway. We're not to the seventh inning stretch yet. So it could keep going. So now, what is this doing to the economy? So the market has peaked. The market is the best leading forward indicator, right? Economic indicator. So I was driving down I live on this island outside of Seattle. Gas is now $5 a gallon here. It's probably less. That's probably more around here than it is in other parts of the country. But so what is this doing? I think this is the higher oil price is applying the coup de grace to the U.S. economic expansion. So think about it. Where are we? We had all that stimulus, right? The COVID hit. They freaked out like in Y2K back in 2000. The Fed printed trillions of dollars of money. The U.S. government spent trillions of dollars in all this fiscal stimulus. Then they pulled the plug on that a while back, not fiscal so much, but the Fed's been doing QT. It's been draining, raised interest rates by 550 basis points, I believe. So I think we're dealing with the lagged effects of all this monetary tightening and pulling the plug on stimulus. And I think the oil price, typically going into a recession, the oil, not always, but typically you get a rise in the oil price while the recession is already starting and the stock market's going down. Then the oil price peaks, after a few months into it, and starts going down when everything goes down together, commodities. That's where I think we are. I think the oil price is squeezing the economy. It's squeezing the U.S. consumer for sure. And let me just go through some of the sector rotation stuff. So so I do a stronger and weaker U.S. industry group forecast. It's longs and shorts, basically, page 6 of the Belkin report. And until about a month or two ago, I had autos, airlines, all that stuff as outperform prospects. And it was working. Consumer groups, restaurants, retailers, they were all working as longs. That completely changed, about the last time you had me on. So now I have for outperform, I have energy service, oil and gas, energy MLPs, which yield huge amount, 7%. These pipeline operators, I think they're still a nice conservative way to play the energy thing. Coal. But after that, what it's flipped into, the sector rotation is flipped into defensive outperform. So that's consumer staples, utilities, which nobody likes. These are the most hated. But these are risk-off sectors and groups. And when big portfolio managers get nervous about the market, they basically sell all their tech and cyclicals, and they rotate into consumer staples, utilities, healthcare, and maybe REITs. That's maybe bottom of the list. So that's what I'm starting to get. And so what is the sell? The market is like, the top of my sell list is New York FANG, so Tesla, Meta, AMD, NVIDIA. By the way, NVIDIA is down 5% this week. Anybody notice that? The favorite AI stock. So to me, this AI boom is, it's real, of course, but it will amount to something, but not the way people expect now. Free market economy, everything changes. Their competitors come out of left field. And so anyways, NVIDIA is down 5% this week. Semiconductors, these are my shorts. Software. Oh, so by the way, software stocks, the same kind of stocks that were in the bubble that Tiger Global was long, everybody has jammed back into these things, right? And these are now my top shorts. So Broadcom, NVIDIA, AMD, ASML, you go down the list. Wait a minute, those are semiconductors. Datadog, TTD, Monster, Shopify, Coin, Hubs. These are the tickers. These are the stocks that blew up Tiger Global, right? And here we are back again. These people are loaded up to the gills in these things.
Right.
And, there's an old saying, a dog returns to his vomit. I hate to be, too.
Have loves dogs.
Yeah. Yeah.
So anyway, these are my shorts. The model, this is not like me thinking this is not a subjective thing. This is what the model's coming up with. Internet stocks,
Well, the sense I get, Michael, is that, for a lot of these portfolio investors, they can't not be in these things right now, right? They kind of have to. They're limited, and their investors kind of are asking them why they're not in these things, because the perception is that they're doing so well on the tech side.
Yeah, sadly, yeah. So I won't even mention any names, but even one of my clients who's household name hedge fund manager, I saw his letter saying, oh yeah, we covered all our shorts and now we're long all these these FANG stocks because it's the only game in town. This was like right at the top, 6 weeks ago. So sadly, that's how sentiment is. The market is like this big vice, it tightens, squeezes you in the vice and makes you capitulate.
Right.
So sentiment is a big part. One of my smartest other clients is a big sentiment fan, and they always want to know when sentiment is leaning too far one way or the other. And so does anybody like defensive stuff now? No. Do people like energy? Maybe a little, not so much. And there's no big flows into it or anything. And do people love tech? Absolutely. So I think that's basically what's going to, there's going to be this big squeeze out of this stuff. If I could just go a little bit further globally. So in the context of a global top for equity markets and the economic cycle, there were huge inflows into EM, right? And one of the biggest was Mexico. So Mexico, for some reason, the Japanese, the Japanese retail investors, maybe Nomura, somebody pushed these things into the Mexican peso, Mexican bonds. If you look at charts of Mexico, the peso got incredibly strong, and the Mexican stock market went to the moon. It's been falling apart. So it's down 4% this week. Same thing with Brazil. So we're getting this global flush. And if you've been around as long as I have, been through a few cycles, when EM starts getting cold feet, basically the currencies start weakening, the bonds, interest rates start going up, there's capital outflows, the stock market starts going down. It's all part of the same risk-off global move. So I see this big risk-off global move just starting. So where are we? Beginning of September. The 3-month view for the U.S. market points down. So I would be short. A couple of things that are nice trades. VIX. The VIX looks incredibly depressed to me right now, right? So VIX call options. There's a big game. There are big vol sellers. Don't ask me who they are. I don't know if it's a conspiracy or what. I mean, it's part of the zero-day option thing. People just sell options and it depresses volatility. But if we start getting big moves, so right now, volatility's been depressed. Realized vol is low. It's like you barely get 1% moves in the market. That's like a big move. But if we start getting 2-3% moves, those can be up and down. By the way, in a bear market, it's treacherous. So the danger is to sell them in the hole, get bearish. Oh, it's breaking down. Sell them, get squeezed. You buy it, you short them in the hole, then it goes up 4% in your face. You buy them back at the top. So that's not the way to operate. Sell the rallies. So that's why I'm telling clients we're going into a higher volatility market, like intraday rallies. Like today, we're up a little bit. Sell them, short them. Buy VIX when it's down, when they're crushing it. Look out for tech. And there's this big retail investors. It's hard for they might not be aware of some of these trades, but there's. For instance, one of my clients is an alpha capture fund. They've got, I forget, almost 200 contributors, sell side, buy side, brokers, independent guys like me. I'm ranked number 1 in that. I was ranked number 1 in the first quarter. I'm up about 16%. That's market neutral. So the point, I'm not boasting, boasting, tends
Boast.
to.
That's good.
Look out, when you boast, something comes out of left field and destroys you. But the point is, it's long, short. There's an opportunity to be things like long energy, short tech. And I'm even buying things like in their American AT&T, right? Telephone, Verizon. These are really depressed stocks, defensive, high-yielding stocks, out of favor. Maybe not huge absolute gains, but huge outperformance possible. And even gold stocks. So gold stocks are almost there in the forecast. I'm just about ready to push the button on gold stocks, which is a defensive group which outperforms. So that's it.
No, that's not it, Michael. There's one other thing. You mentioned EMs. You mentioned some of the previous discussions. I want to ask you quickly about China. When we spoke last time, you were a little bit positive about China, and it hasn't seemed to go well. So is there a chance that we see kind of a resurgence in China, or is the opportunity past?
Good question. Yeah, that one I've been wrong on. I think I attribute it to their reluctance to go full bazooka on stimulus. If ever there was a time and a place where it's appropriate for huge monetary and fiscal stimulus, it's now. But I mean, Xi, he's saying, he's afraid to do fiscal stimulus because it's going to make the consumers, Chinese consumers, weak. I think they'll be forced into massive stimulus eventually by how bad things are. But I'm standing aside there now. In the Apple news, this is really economic warfare, So they're not, everybody knows this by now. They're not allowing anybody in the government or even state-owned enterprises to use Apple phones at work. So that's kind of a response to the restrictions the U.S. has put on semiconductors. So there's this tit for tat thing that makes me really nervous, and it could be that China is completely uninvestable. So right now, I just don't know if they go full tilt boogie on stimulus at some point. Then that market could start to go up just on money creation, right? We're not there yet, so I'm standing aside for now.
Great. Okay. Michael, thanks. That was very comprehensive. Really appreciate that.
I had a question for Michael really quickly. Actually, it's about base and industrial metals. Given this kind of green transition, do you think that are we just waiting on China demand, being that they're the world's largest commodity buyer, for this to take off? I mean, we have LME inventories at lows, but yet we're seeing prices at lows as well. So I don't know if you had any thoughts on kind of that sector.
Yeah, so base metals, kind of neutral. I agree with you. They're very low and they're enticing. If you just look, you want to buy low, they look interesting, and you think nickel, is going to be in batteries and everything. I'm not getting a signal on those at all right now. So I think the economy is going to head down, and a lot of these EV stocks, the battery makers and things. I just think if the economy goes down, the whole rationale for owning these things is going to get pulled. And so, for instance, in Europe, autos are one of my biggest shorts there. So it's towards the middle. The top short is tech, but so Mercedes, BMW, Porsche, all these VW, all these companies. I just think the economy goes down, auto sales are going to go down, and there's going to be the demand scenario might not be as strong as people are anticipating for now, for a down cycle in the economy. So no, I'm not bullish on base metals at the moment.
Okay. I also, on your auto comment, I think, is that the volume or is that the pricing power? So do you see fewer cars being purchased, or do you see those automakers losing pricing power, the pricing power they've had over the past few years because of supply shortages, or is it both?
Both.
Okay.
So the economy tanks. So basically, Germany is a big auto manufacturing plant, and export. That's kind of what they do, and the stocks are extremely popular with international investors, right? But they've been dogs, and they're just starting down. So direction, position, intensity, we're only second, third inning down. So basically, the model doesn't answer your question precisely, but it gives the implication that car sales the economy is going to go down. People are going to have less money to spend. They're not going to be buying new cars so much, so they're too expensive anyways at the moment. So you know how that works in an economic cycle. That's what causes a recession. So the sales fall, companies start cutting production, they start laying people off, canceling orders, suppliers orders go down, et cetera, inventories go up. That's what we're headed into, I think, an inventory correction, a classic economic recession.
Very interesting. It'll be interesting to see. So thanks for that, Michael. Tracy, let's move on to some of your comments about LNG and EVs this week. Everyone's mentioned EVs so far, so I can't wait to dig into that a little bit. You made this post about LNG in Asia this week, talking about Asia's growing dependence on LNG, being the largest importing region and doubling by 2050. So, being from Texas, that's great for us. You also mentioned how gas is likely to outperform wind, solar, batteries, which is interesting to me, given that China is pushing green tech so heavily. So can you talk us through the importance of global gas demand, as well as the adoption of things like electric vehicles in Asia?
Well, I think, first of all, if you're talking about Asian markets, and, we can lump Africa into this as well, even though it's not Asia. And we're looking at the LNG market, right? It makes sense that you would make the transition from coal to LNG and then perhaps to renewables, right? Because they still need cheap energy. It's clean energy. It makes sense for that jump to happen. You're not going to jump from coal to wind. It's just not a natural technology evolution. So it makes sense that the LNG market would grow specifically in those areas. And, and we're seeing that it actually grow in Europe as well, too, right? Well, or if you look at Germany, they're going backwards and investing in coal again. But aside from that, so it's a natural transition. There was just a big gas tech symposium in Singapore this week. So it was everybody from the LNG industry. And if you look at really the supply demand and what kind of those orders are looking like for some of those larger LNG companies, particularly many in the US, that just makes sense. And as we in the West are talking about cutting off, we want to end fossil fuels by 2050, whether or not you can actually do that or not, it's a totally different question. But, that is the stated goal at this point. We're really going to see, especially in these emerging markets, fossil fuels grow as they move out of coal and into things like LNG, just as, here in the West, how that naturally happened.
Okay, so as they raise their dependence on gas, so India, China particularly have huge dependence on coal right now. And not a small portion of their economy is focused on mining coal, Indian coal miners, Chinese coal miners, that sort of thing. But as they transition to more LNG, are there gas sources in Asia outside of, say, Indonesia, Malaysia, a little bit of, say, Myanmar and so on, but are there large gas sources and gas fields in Asia?
I mean, there are some, and a lot of that, is coming from Russia as well, right? They have the Siberia 1 pipeline. They're building the Siberian 2 pipeline. You also have large gas sources in Africa, so to speak. So there's a lot of natural resources that are still stuck in the ground at this point. If we're talking about gas, I mean, it's very abundant in the West as well. Obviously, Europe doesn't frack, and so we don't see that coming out of European markets, but certainly in the US, it's a big, it's a big abundant energy source.
Okay, so let's also talk through EVs, because you mentioned that in this tweet as well, and we've talked about it with Anas and Michael. With the transition to gas, will those grids have the, say, feedstock and capacity to power the EVs that are expected to come online across Asia in the next, say, decade, 2-3 decades?
Well, expected is the key word here at this point, which you mentioned, because, we've seen a lot of these very aggressive goals from, say, the IEA, which puts out, what they think this is going to be. But in reality, we have to look at, we have to understand that right now, as far as energy is concerned, we're in higher for longer, right? We have energy scarcity right now instead of energy abundance. And so I think it's going to be higher for longer. Does that mean it's going to be $100 oil from here on out? No, I'm not saying that, but it's certainly not going to be, we're not going to see, $20 oil for any length of time, probably, well within our lifetimes. And so I just think it's higher for longer. It's scarcity is concerned. I think this is going to be a very big problem when it comes to EV and EV production, which requires a lot of fossil fuels, right? You have to mine for all these metals. You have to charge these. Cars. Most grids are still based on some sort of fossil fuels, and renewable energy mix is still a very small portion of that, and not to mention the problems with intermittence.
Isn't it strange though? And I don't mean this to sound as cynical as it's going to come off, but we've had a push for alternative energy for the last, say, 20 years. I mean, trillions of dollars of subsidies with solar and wind and other stuff. But we still have supply constraints. We still have a deficit of energy in fossil fuels. So there's been this massive push to have more of the feedstock as these alternative feedstocks, but we still don't have enough fossil fuels. Why is that?
Well, because we have these green transition goals, right? And so the West is really pushing for this, whether they're realistic or not, that's up to debate. But at this juncture, when you're telling oil and gas companies, we want to phase you out in the next 10, 15, 20 years, how much CapEx are you going to throw at that, right? You're just not. And so we're seeing that. And, we've seen the same sort of lack of CapEx in the metals industry. This includes mining for cobalt, nickel, and all the things that you need for EV batteries, which is also going to be a challenge. And I think combining this scarcity factor in metals and mining and in oil mining, we're going to have a big problem as far as how much EVs cost. And so when you're talking about these emerging markets, and you're talking about EVs that are suddenly, 40, 50, 60, these people can't afford those kind of vehicles. It's just completely unrealistic at this point. Yeah. And so I think, although these goals seem idealistic, they're just in practice are not. And we're going to suffer the consequences of this over the next 20 years because of the scarcity this is creating and the things that we need to make these sort of changes.
Right. So with EVs and, both you and I know Anas has written a lot about EVs. So we have a subsidy for the EV manufacturer. We have a subsidy for the battery manufacturer. We have a subsidy for the consumer purchaser. And, what is the true cost of an EV? That's what I don't understand, because there are subsidies it seems to me, at every step in that value chain.
Absolutely.
So what am I missing? I've got those 3 subsidies. What other subsidies am I missing?
So, I think that if you look at the Inflation Reduction Act, it's, where do you source your materials? There's a lot of embedded subsidies within green infrastructure or green transition renewables, not just EVs, but also, wind and solar. Depending on, where are you sourcing this? Are you using American-made parts? There's a lot of embedded subsidies, which a lot of EVs can't even capitalize on, because a lot of those materials are not sourced within the United States, and those kind of were incentives to get people to drill for those materials here in the United States. But then you look at our permitting process, which takes 10 years. And so that adds, a whole nother problem.
Add to that, that the Department of Energy, the Biden administration is giving GM $12 billion for it to build its factory. That's something on the side. And the other related issues is all the research that's being done free for them at the Department of Energy.
Yeah, I'm not anti-EV. I just want to be clear. I don't have an issue with EVs as just an object. I just want to understand what is the true cost of that, because if we're supposed to see this EV adoption in Asia, particularly, which is, largely middle income and emerging markets, who's going to pay for that? Because the countries themselves, let's say in Indonesia, they can't necessarily pay for all these subsidies, right? And so, are we necessarily going to see the grid impacts that we've seen in places, say in Europe and the US and other places, in a place like Indonesia?
No, and that doesn't even include the cost of the overhaul of the grids. Right? You have to completely overhaul your grid for this. Electricity, people think electricity comes from your socket. No. Right? Electricity comes from burning fossil fuels, generally in those countries, whether they be coal or natural gas or, crude oil. And so there are a lot of things that, that are very altruistic about it. And what I think, especially if you're looking in, and I'm just going to throw this out there, especially if you're looking in DM markets, right? The United States, and all these people that want to go to these EVs, really, I think hybrid vehicles are kind of a missed and overlooked niche market here, right? Nobody's really talking about hybrids, but that kind of solves a lot of the in-term problem. Again, they're not inexpensive, so I'm talking for
Right.
DM markets, but it's incredible to me that people really aren't looking at hybrids more, especially because we don't have charging infrastructure in the United States. That you can't drive across the country
Yep.
probably and make it on an EV alone.
Yep. And hybrids aren't cool anymore, Tracy. They were cool in 2005. They're just, it's just
Not cool anymore.
It's not cool anymore. So, okay, guys, this has been a great show. Thank you so much for all that you've contributed, all the amazing thoughts you have. I appreciate all of that. Have a great weekend and have a great week ahead. Thank you so much.
You too. Thank you.
Thank you.
Thanks, Michael. Tracy. Bye.
That's it for this week's episode of The Week Ahead. Please don't forget to rate us and review on whatever platform you are watching or listening to this. Thank you.